capital and how has capital become such a powerful force in our world?
See JP Morgan, the man, not the bank, emerging around the turn of the century, around 1900, as one of the most powerful figures in the United States.
As finance gets more adventurous and then the government tries to tame it, the story sounds eerily similar to tug of war between big tech firms and governments.
Finance, when it goes wrong, can be systemically problematic in a way that I'm not sure tech has ever been so far. One of the linguistic oddities is that both venture capitalists and hedge fund managers use this term carry. Why do they call carry? It's because it derives from ships. The ship would come home. If it came home successfully, then 20% of what had been carried would have been kept by the sea captain and his crew. When you look at venture capital managers' investments, they look a little bit like somebody in a casino, goes 0, 0, 0, jackpot, 0, 0, 0, jackpot. So it looks like luck, but it's not luck.
From Wall Street to the Silicon Valley, has the relative power shifted?
Wall Street has been regulated and sort of tamed. And on the other hand, technology has become more and more dramatic in its progress, and artificial intelligence is just the latest manifestation.
Hello and welcome to today's episode of the Great Tech Game podcast, where we bring you smart, insightful, big picture conversations with some of the world's best thinkers on issues ranging from technology, geopolitics, and business. And today I'm excited to have with me here Sebastian Mallaby. Sebastian, as many of you will know, is the Paul Volcker Senior Fellow at the Council on Foreign Relations and the author of 5 great books. The most recent one being The Power Law, which is about the venture capital industry. There was a book that came out, I believe, in 2016, The Man Who Knew, which was about Alan Greenspan, which also, I believe, won the FT Business Book of the Year award back in 2016. More Money Than God, which is, I think, my favorite title of the various books you've written, Sebastian, which is about the hedge fund industry and more. And Sebastian, obviously, in addition to CFR, has also worked previously with some great publications, the Washington Post, the FT, and The Economist. So I'm super excited to have you here with us today, Sebastian. Welcome.
Well, great to be with you, Anirudh. Nice to be with a fellow author. I'm looking forward to the discussion.
No, thank you. Today there are about 4 broad themes I want to cover with you, though I know that given the kind of span of topics that you write about and that you study and have looked at, we might veer off course a little bit during our conversation. But the 4 broad themes I'm hoping to cover with you today are: one, I want to talk about what in my book I've called the Great Capitalism game, but really this era where capital suddenly becomes such a big shaper of our world, of our world's economics, our world's geopolitics, our world's values and our society. I want to talk about the 2 industries you've written specifically about, the hedge fund industry and the venture capital industry, the latter of which I've been closely associated with for over a decade now. And then I want to move into a topic which is close to my heart, which is the rising inequality in our world and the impact that might have on capitalism as we know it. And I want to end our conversation talking about the future. And I think as part of that, I want to talk to you about the emerging powers in our world and what implication that might have for our world order going forward. So those are the broad 4 themes I want to cover today, hopefully in the next hour or so. And so let me dive right in with the first big question I want to ask you. You've written a lot about this from various angles, the power of capital. And so tell us from your perspective, Sebastian, why you think, going back into history as well, why has capital and how has capital become such a powerful force in our world?
I think the big shift came with the Industrial Revolution, actually, because once you had, electricity, steam, rail, and so forth, it suddenly made sense to produce goods on a large scale. I mean, before around 1840, the standard unit of the American economy was the one-man shop, because you couldn't bring in inputs from a long way away, you couldn't sell at a long distance, you couldn't have mechanization, so there was no sort of economies of scale from spreading those capital expenditures over a bigger operation.
Yeah.
Um, so that was the time of essentially small companies and therefore small finance. Once you get big companies, and particularly the revolution of allowing joint stock companies, then you need shareholders, you need bigger debt markets, and finance becomes very important. You see J.P. Morgan, the man, not the bank, emerging around the turn of the century, around 1900, as one of the most powerful figures in the United States. And I think that's the moment when finance really emerges.
And one can argue, maybe if you go back even further, Sebastian, as I've tried to go in my book as well, if you go back into what I call the great trading game, or the great trading era that we see, where global trade becomes possible, right, through better oceanic navigational technologies, etc. Of course, you hear stories of colorful characters like the Medicis, right, and powerful bankers that fund trade, right, global trade. Was that also maybe the early starting points of the power of capital that then builds into maybe what you've rightly mentioned as the era when it suddenly scales up, the need for capital and the power for capital?
Yes, I agree. And I'd say that the common theme here is that technology often drives these changes. So, as you said, oceanic navigation, when that becomes technologically doable, then you need finance to sort of pay for it. Um, and trading over larger geographies also required trade finance. So you're right. My choice was highlighting a different kind of emergence, the sort of company finance as opposed to trade finance or project finance. Um, but clearly, any historical story is going to be subtle. There's going to be multiple watersheds along the road.
Yeah, and layers, of course. And of course, you've written about capital from various perspectives, but tell us maybe some characters, like you obviously just mentioned J.P. Morgan. I was mentioning the Medicis from many centuries ago, but tell us about some of the colorful or characters that you've come across in your research that maybe in some ways exemplify the power capital has exerted on our world.
Well, I'll pick one from the hedge fund world and one from the venture capital world. So,
Sure.
from the hedge fund world, I think the story of George Soros, the first really powerful global macro trader, kind of exemplifies the power of capital. He forced the devaluation of the British currency famously in 1992. And then he was at the center of the later devaluations in Southeast Asia, which began with Thailand in 1997. So you have there an individual, operating out of a smallish office near Central Park in New York with duct tape on the floor, and he looks like a small operation, but actually governments are quaking before him. And then from the venture capital world, I think I would choose Arthur Rock, who, as I describe at the beginning of my book, The Power Law, is the figure who goes out to the West Coast and does the first proper venture capital deals on the West Coast. And because of the success of that formula of risk capital for technology, he starts something which ends up creating both sort of Silicon Valley and, broader than that, just the most successful innovation hub that we've seen in history. And I think that was down to the nature of Arthur Rock's financial innovations and how influential they were.
Yeah, somewhere I think in one of your articles, maybe or maybe in your book, I remember seeing the term adventure capitalists. And as I remember from the history research that I had done for my own book, I remember you seeing that term being used back a few centuries ago when expeditions were taking off from Spain and Portugal, right, to find the Americas and other parts of the world. And the people who were at that time the explorers, they were often that entire I guess, phenomenon was often termed as adventurers, the folks who were going out in adventure capitalism. And that time also, I remember finding lots of similarities between the venture capital industry as it exists today and what you're arguing Arthur Rock also in many ways seeded in Silicon Valley, and people 500 years ago maybe who were doing very similar kinds of exploratory and risky expeditions.
Yeah, one of the linguistic oddities is that both venture capitalists and hedge fund managers use this term carry, meaning, they raise some capital, they invest it, and then they take 20% of the profits on those investments and return, 80% to the limited partners who gave them the capital. Why do they call that 20% which they take the carry? It's because it derives from ships that were carrying some valuable cargo.
Correct, silver
And
or whatever it was.
yeah, and then the ship would come home. If it came home successfully without being sunk by pirates or whales or whatever, then 20% of what had been carried, literally the physical goods carried, would have been kept by the sea captain and his crew.
No, that's right. That's right. And I think it's amazing that that particular one I actually did not know. So thanks for sharing that. I think uh, it's interesting how certain terms can come back 500 years later and then again, shape the world in such powerful ways, much like those expeditions, did for our world back then. Um, but the other piece that I'm very curious to get your views about is, of course, there are individuals like Arthur Rock and Christopher Columbus and Vasco da Gama and George Soros that we can talk about. But for any game, right, any such big force or shaper of our world like capitalism has been, and now tech is, you often find that there are many players, right, and it's almost like a multiplayer game. And as I have seen both personally as well. The great capitalism game, what I've called it, but really this industry, right? The capitalism industry or capital industry, really, or financing industry has many players. Often has individuals, powerful individuals, as powerful rich individuals, has governments, has regulators. For the last couple of hundred years, maybe 100, 150 years, as this other beast called central banks. Of course, you've written about Alan Greenspan. And then, of course, you have commercial banks, right? And then various other players. So I want to ask you about how, in your research and in your studying of these different worlds that you've studied, right, from central banks to hedge funds to venture capital industry and so on and so forth, how have you seen the relationship between these players evolve over? You can pick the time frame over the last few couple of decades, if that's interesting, or over the last couple of centuries.
Well, let me talk broadly about the last 100 or so years in the United States. I mean, if you look at the cycles, you clearly see that there are moments when, finance gets too chaotic and then the government clamps down. So, there'd been this period right at the 1900s where there was no central bank and private banks were running amok and creating way too much credit, and there would be a bubble and then it would burst and everybody would lose money, and there was no central bank, so there was nobody to bail out the system. And JP Morgan, who I mentioned before, would sort of do it privately by convening people in his library and locking the door until they all agreed on a way of sharing the pain of bailing out the system. But that didn't seem like a sustainable model, and that's why the Federal Reserve was
And
created.
these people at that time were
They
politicians, or were they
no,
fellow
they
bankers? Who was
they
in
were
control?
the heads of the various banks on Wall Street.
Okay.
But there was no way of coordinating a bailout unless you had the most powerful of those bankers sort of step in and go from essentially being a private banker to being a kind of public leader. And so they kind of formalized that idea by creating a proper public institution, the central bank, to act as the lender of last resort, to step in when there was a crisis, to stand behind the banking system when that was necessary. So you had a regulation of money in that sense. Then you get another period of wild excess in the 1920s with an enormous stock market bubble which then becomes a crash, all sorts of, unsavory practices, fraud and so forth being practiced during that bubble. And as a result, the government clamps down, creates the Securities and Exchange Commission, and regulates finance, which is then sort of fairly quiescent and dormant after the Second World War through the late 40s, 50s, and 60s. And then, there are various loopholes that are discovered in the SEC regulation. Finance starts to get a bit wilder again. The regulation had some inefficiencies, so the politicians allowed that wildness to build. And it builds and builds and builds. You get securitization, you get all kinds of derivatives, you get way more leverage in the American economy than you had ever had before. And that all comes to a head in 2008 with the financial crisis. And then again, the government, bang, comes in, clamps down, imposes new regulations, and sort of tames finance, makes it more boring. So I think you see these cycles
Yeah.
between the government's tolerance of financial innovation and then periods of intolerance.
No, so I think that's a great description of the. You can call it the ebb and flow, as you know, in a previous podcast conversation we termed it, or you can call it the tug of war, which is the title of a chapter. Incidentally, as you were talking about this back and forth, right, where finance gets more adventurous, and then the government tries to tame it. The story sounds eerily similar to how you might today describe the tug of war, at least how I've described it, the tug of war between big tech firms and governments, right? Where there seem to be, much like we're seeing in the world of AI as well. We saw it with social media over the last few years, where big tech firms tend to use whatever flexibility they have in the system to push the boundaries, and at some point they run into the state or the government saying, "Hey, listen, now this is you're overstepping, and time to tame you, or time to regulate you, or time to call you to congressional hearings and please give you, a mouthful even if we don't break you up." Do you see those similarities between how finance was being tamed over the last decade and went through these cycles, and maybe how governments and tech firms are now, you know, maybe playing a similar tug of war?
I mean, I think you're right. There is a similarity. I think the distinction would be, though, that finance, when it goes wrong, can be, systemically problematic in a way that I'm not sure tech has ever been so far. So what I mean is that, in the 1920s, the excesses created the Great Depression, and people were, absolutely lost their livelihoods, and it was huge amounts of human suffering. In 2008, the world economy crashed. Hard to think of a tech thing which, sure, it's caused problems with privacy, it's caused problems with,
Elections.
yeah, there have been serious effects.
Yeah.
Um, but I don't think it's caused a really acute recession ever. So maybe the sort of swings are more extreme with finance.
Yeah, yeah, yeah. And as we were talking about the way at least governments and financiers or banks have been dealing. Of course, in addition to that dynamic, the other question that arises, and I think this now maybe starts to we'll start to bring a couple of your books into this conversation, which is the rise of two new players, right, which did not exist necessarily in the 1920s and 30s, but as you've argued, I think in your books as well, have become increasingly powerful players in this capital game, which is the venture capital industry and the hedge fund industry. So, talk to us about how you feel, maybe starting with the hedge fund industry first, how you feel the hedge fund industry has changed the rules of the game in a way, or has maybe even threatened to dislodge maybe some of the existing powerful players in this game.
Well, I think as the traditional banks have been increasingly regulated, um, small institutions and hedge funds are, in relative terms, small. on the whole.
Correct. Small maybe in
You
terms
know,
of number of employees, but not small in terms of the capital that they sit
well,
on.
but I mean, compared to big banks,
Correct.
they are
They're the
just
smallest.
they are quite small. My point about smallness has become less true over time. They've grown and grown and grown. In my history of hedge funds, I describe how it was a huge deal when you had $1 billion under management. The first hedge fund to do that was in the early 1990s, and now, of course, 25 billion is modest, and there are many which have 250 billion. So you're right, it's grown, but compared to the assets at Citibank or JP Morgan, it's nothing. Um, and because they are too big to fail is the famous catchphrase explaining why you have to regulate big banks. Hedge funds in relative terms are small enough to fail. You can let them fail. It will not crater the whole economy. And because of that, it's okay to let them do what they want a bit more, because it will not have such huge, wide social effects if they go wrong. And I think that allows hedge funds to innovate in trading methodology. And so a lot of the price discovery that goes on in public markets, where somebody's really doing the research to think about whether this stock should be more valuable than the other stock, which is the better company? Is it, Ford, or is it Tesla, or is it General Motors, or is it, which one?
Be right.
And the people who are incentivized to really do careful research about that are hedge funds, because if they get it right, the hedge fund managers will personally get extremely wealthy, and that is not really the true same thing with banks.
Yeah, and what about the venture capital industry? Of course, your most recent book, The Power Law, talks about the, I'll let you explain it, the power law itself, and how that in many ways is a very different way of coming at it than the hedge fund industry.
Yeah, so in most kinds of finance, if you look at the returns on a given stock in the stock market, they're going to fluctuate up and down, but on nearly every day, the fluctuations will be contained to 3% either way. And if you were to plot all the fluctuations from all the days, you would see this big cluster where it kind of clusters around zero. And, sort of either side of that zero mark, 3% up or 3% down, accounts for two-thirds or something of all the observations. Whereas in venture capital, a venture capitalist goes out, invests in, let's say, 20 startups, and it would be perfectly normal for 15 of those startups to basically go to zero. No returns at all, 100% loss. And then, a couple will go sideways. And if all is good, three will hit the jackpot, be right off in that right hand tail where it's not 3% up. It's sort of, 300% up. I mean, it's a very, very big increase. In fact, no, sorry, 300, that's wrong. So 10x would be the minimum. So 3000x, I should have said. Yeah, 3000x. So that's a proper, venture capital home run. And so when you look at hedge fund managers, I'm sorry, when you look at venture capital managers' investments, they look a little bit like somebody in a casino. Goes zero, 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 jackpot, zero, 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 jackpot. So it looks like luck, but it's not luck. It's about intelligently taking a bunch of bets that have a positive expected return. Because although inevitably with startups, most of them are going to fail, you have a good shot at getting those 3 out of 20 that really make it big time.
And do you feel that there was a reason why these two, at least in particular, forms of capital deployment didn't end up being subsumed within the larger banks? Because if you look at the large banks, like the ones we've been talking about, often they'll have multiple divisions, they'll have multiple small teams, they'll have the special situations groups and the strategic opportunity groups. Why is it that these two particular forms of capital deployment, in particular, have ended up being often these small teams and outside of the context of the large banks?
I think it's about incentive structures. Trading an investment is, a high stress occupation. If you do it well, you have to be really, really focused on it. and the difference in terms of your returns between being sort of a normal, intelligent person who does a reasonably good job, which, because you're up against in the financial markets lots of other people who fit the same description, probably won't make you any return. And then on the other hand, being somebody who's right off in the right hand tail of the distribution, who is just completely focused and totally aggressive about it. Those are the people that are going to make, serious returns because they're going to be that bit better than, the bulk of the very smart people who are trying to do this. And so it's all about these high powered incentives to get that high powered performance. And if you think about a hedge fund, on the downside, the hedge fund manager who does badly will lose his own money because typically he does have his own capital, his own savings in the fund. And so there's a big incentive on the downside not to mess it up. And on the upside, he's going to keep 20% of the profits from the investment. And that's a chance to get seriously, seriously rich if he does the extra research it's going to take to make the right investment call. And if you're inside a bank, there's always this feeling that, if you do badly, it's okay. Some other part of the bank will absorb your losses. And if you do well, yeah, you'll get a bonus, but it won't be that you get 100% of what you might have deserved in your own mind. So I just think that, and it's the same with venture capital, by the way. There are lots of attempts by corporations to create corporate venture capital
That's right.
operations. And the people who work at those have less high powered incentives and they tend to do less well.
That's right. That's right. The other interesting aspect, of course, that you've written about when it comes to the venture capital industry in particular is the globalization of it. In many ways, even though it has, as we were talking about in the case of Arthur Rock, seeding it in some ways in Silicon Valley several decades ago, more so than the hedge fund industry, I think. The venture capital industry has now spawned its wings, spread its wings to other parts of the world. Right? You've written about, I think, Silicon Valley and Europe, whether Europe can replicate it. China, of course, India, and this is something I've personally lived through. I was in the US setting up a venture capital fund, and then decided to move to India to set up the VC fund here. And in many ways, so personally, I've seen that global expansion of the VC industry. So, talk to us about that. Do you anticipate that the VC industry, and I'm going to try and use a parallel from international relations here, do you expect Silicon Valley to be the unipolar leader of the venture capital industry? Or do you expect the VC industry to, over the next, let's say, decade or 2 decades, truly become multipolar?
I think it will be multipolar. And the reason I argue this is that, the way you do venture capital investing is sort of counterintuitive, right? Most human beings we know from behavioral science are, keen to protect their losses, and they're willing to take quite a lot of risk actually to protect themselves, to sort of make up a loss on the downside, but they're not willing to, really take a big risk to reach for that big upside. And venture capital is all about those few companies that make the big upside. So it's contrary to human instinct to invest in this power law fashion. And that's why, for a long time, a relatively small group of people had figured this out. They were mostly in Northern California, and they kind of kept the secret among themselves. And therefore, Silicon Valley totally dominated the game of doing venture capital backed startups. But around 2005, the big venture capital groups in California started to go abroad. And, Sequoia, Accel, and others went to China, went to India, and a bit later, they went to Europe. And all of these places, I think, are going to do well. And, you already see, if you look at the curve of the growth of the number of startups, the number of unicorns, the amount of venture capital dollars deployed in all of these newer geographies, it's very impressive. It's clearly growing exponentially. And that's why I think it's going to be multipolar. The caveat is that there are some places which just have too small of a local market to enable those huge outcomes that you need to pay for the inevitable losses. And so in those places, it's going to be tough to make venture capital work. I was in Kenya recently, meeting with venture capitalists there. And I would love to argue, since I like Africa, I lived in Africa for a bit as a journalist. I would love to argue that venture capital is going to be a terrific hit in Africa. I just feel that until you build a single market in Africa, which we're a long way from, a big outcome in an economy the size of Kenya isn't quite big enough to really make the engine hum.
And do you think those are the two main ingredients then, like the availability of capital by these VC firms, either the global ones coming there or rise of homegrown VCs, as India has seen, and many of these other countries that you were mentioning, China, Europe, Africa also have seen. Is it just the access to capital and the availability of a large market, or is it that there's something in that mindset? Because the other argument I've often heard is that this mindset that exists in Silicon Valley has been critical to adopting the power law kind of investment thesis that VC firms have, which is failure is okay.
Yeah,
15 of the 20 companies failing is okay.
yeah.
I'll wait for that one. Do you feel that that mindset is critical? And if so, are you seeing that mindset travel as easily as maybe the capital has been?
Culture changes, is my view. And yes, Silicon Valley has this strange idea that, failure is a learning experience, and it's an honorable thing to go through. And it might sound odd, but when you get venture capital established in other countries, it's going to change the mindset because you turn a single shot game as an entrepreneur, where if you fail, that's probably your last chance at it, to potentially a multi-shot game where, if you start a company, you get a venture capitalist who backs you, then the company fails, but it wasn't your fault, but maybe something like some big rival entered your market and knocked you out of the water. But the VC has been with you at board meetings, stayed in touch with you, has seen that you really gave it all that you had and you were smart and determined and gutsy. That VC is going to say, right, well, that was a learning experience, and this is a good entrepreneur, and I'll back the next company that this entrepreneur wants to start. And so I always think these cultural generalizations are flimsy. They're just sort of the outgrowth of the conditions, including the availability of venture capital. I'll tell you one quick anecdote, which is, I was discussing this actually with another Indian VC some time ago, just after my book came out, and he told me this story about how when he had come back from America and started doing investments in Bangalore around 2010, it was very hard to persuade people to want to do a startup, and then if you did persuade them, they often had trouble persuading anybody to marry them because the social status the social status of an entrepreneur was a bit suspect. And so this VC I was talking to described how, one portfolio company founder came and said, hey, you can do me a favor by calling my girlfriend's dad and persuading him that an entrepreneur is not necessarily a loser because he'll listen to you. You've been to MIT Business School, and you've worked at Intel as an engineer, so you have status, and you can persuade my girlfriend's father-in-law that I ought to be okay as a son-in-law. And so I said, that's interesting. So what about 2022? Are you still doing this marriage intermediation service? And he said, no need now. Everyone's watching Shark Tank on TV, and they totally get it. And
No,
the
that's right.
culture has changed.
That's right. That's right. No, absolutely right. I think I take your point about culture changing. I think you need certain triggers, often around incentives. I think that can make culture change faster. But that's a funny anecdote, of course. I've also seen similar examples. But now in 2022, it's interesting. I don't know if, given we're talking about TV shows like Shark Tank, which of course has become fairly popular in India as well. But there's another TV show called Indian Matchmaking, which I think is on Netflix. Which if you haven't come across, you should watch an episode or two. And there we have it. Interestingly, when you were mentioning that, I was thinking, have any Indian tech entrepreneurs showed up on this TV show Indian Matchmaking, which is apparently from friends of mine who work at Netflix, they've told me this TV show has become a phenomenon across the world. Um, but yeah, I think we're just waiting for a couple of tech entrepreneurs to show up on TV shows like Shark Tank and Indian Matchmaking for them to become more acceptable grooms and brides in the Indian context. But I can vouch for that. I think that culture has changed. The Indian entrepreneur today is, in many ways, being seen as a shaper of the values, especially for the younger generation. They're influencing through social media attitudes, mindsets, cultures, risk taking, I think across the country. So, in many ways, the argument that you just made that culture can change, and sometimes it's things like the venture capital industry or this risk taking mindset that can then pervade a larger part of your population. It is happening, but it also makes me think about another question that I covered in my book a little bit, which is, I called it the duopoly of our world, technology and capital, right? And if I think your training has been in economics, one of the first few things they teach you is, the GDP of any country is a function of, land, labor, capital, the so-called factors of production. And, I've been trained in economics and international relations, which I know is also the intersection you do a lot of work at. But I want to ask you about this duopoly of technology and capital. Right. Um, First of all, do you agree that these two factors, in a way, and the intersection of those two, given what we just discussed about the venture capital industry, which is often at that very intersection, do you feel like these two are like the two most powerful forces in the world today?
Yes, I do. I mean, I think that partly because Wall Street has been regulated since 2008 and the financial crisis, the most interesting and exciting part of international capitalism is definitely, you know, technology. And if we're interested in finance, it's the kind of finance associated with that technology. So, over the last decade or whatever, a venture capital partnership like Sequoia has been far more exciting and dynamic than Goldman Sachs or Morgan Stanley.
And is that fundamentally true also? Is it just that the sequoias of the world and the venture capitalists and the startup founders tend to be more in the news now, and maybe in some ways Wall Street doesn't mind because maybe it was too much in the news for some time, and now
It's
maybe
it's it's not just a phenomenon of the news coverage. You can see it in stock market valuations. If you look between 2010 and 2020 at the share prices of all the big Wall Street firms, they went up by a fraction of the amount by which tech valuations went up. If you had invested in some combination of Goldman Sachs, Morgan Stanley, and J.P. Morgan versus putting your money into Apple, you would have made way more from Apple. Um,
yeah.
so I don't. It's not just a impressions thing. It's actually where real value is created.
Fundamentally values being created. Which leads me to the other question I want to ask you, which is, you mentioned the power law. Another person I had on the podcast, John Gordon, he wrote a book almost a couple of decades ago about Wall Street, which incidentally he called the Great Game, right? And he and I were having this conversation about whether power has started to shift from Wall Street to the Silicon Valley or Silicon Valleys of the world. Would you agree with that characterization? Has the relative power shifted?
Yeah, look, I do think so because of this point that Wall Street has been regulated and sort of tamed, and on the other hand, tech, because of Moore's law type effects of sort of exponential growth of the power of the underlying technology, has become more and more dramatic in its progress. And artificial intelligence is just the latest manifestation of that, where things that were unthinkable 18 months ago before ChatGPT was released have now, they're on everybody's computer screens. And so we really do live in a time of extraordinary technological change.
That's right. And this exponential technological change, these kinds of exponential returns that VC firms see, entrepreneurs see, raises another very interesting, but I would say very significant question, which is that of inequality, right? And if I was to invoke again history a little bit here, um, when industrial capitalism is at its peak, right, and I'm talking now, let's say pre World War One Europe and America, you find massive forms of inequality on two levels. One is there's the great divergence, of course, that the Industrial Revolution spawned, right? Where you suddenly see Western Europe and their growth rates far exceeding countries that were not industrializing, right? But those countries had previously been massive parts of the global GDP. But suddenly you see this great divergence between nations. But the same effect was also happening within nations, where you were seeing this economic divide between the industrial capitalists and other classes of society, right? And one tends to think that the moment you start to see these kinds of exponential returns and exponential um, returns to capital and exponential rewards for entrepreneurs, risk takers, you often find that inequality is a byproduct, right? Both within societies and among nations. And so, from your perspective, are you finding that this kind of tech driven economic world that we're living in, where tech is really the economic engine for many nations, are you seeing this kind of divergence now happening? And if so, would you say you'd be worried about the kind of inequality levels we are seeing across the world now?
Yeah, a few years ago, just before COVID, I went to the Jaipur Literary Festival and gave a talk about one of my books. But I was also a sort of support act on a big stage with Thomas Piketty,
Of
the author
course.
of Capital, who was,
That's
pushing his book. And of course, his book was, of massive interest to the audience. There was an absolutely kind of packed group. And so there was Piketty out front talking, and there was a sort of, modest cast of two or three people, myself, my friend Arvind Subramanian, who was, I think, working for the Indian government then as maybe the chief economist,
he was the CEO.
and some other.
Yeah.
So in any event, so there we were. And of course, Piketty's central claim in his book was that there was sort of this ineluctable process whereby capital was increasing its share of the total pie, and workers were losing share.
Labor was not correct.
Yeah. And he produced some sort of, quasi science around this and said, the rate of growth would always be exceeded by the growth in the stock of capital. And it turned out to be nonsense. I mean, there just isn't a there. There is no iron law about the way that when you combine all the factors of production, which you referred to, you know, labor, land, capital, ideas, um, who gets what is not predetermined. And it goes through cycles. And sometimes the political economy around, a particular set of ideas and capital stock and what have you favors the workers, and other times it doesn't. Sometimes it favors diminishing inequality across countries or between countries, and other times it's the opposite. And so I think the first thing to say is that be skeptical of people who say there is an ineluctable trend, because there isn't. Recently, in the United States, the data is showing that in country inequality is radically diminishing, right? It increased in almost a straight line from the late 70s to just before COVID. Since about 2019, it's come back down again, right? So these things can be reversed. And, it's complicated. You can measure inequality in lots of different ways. I think it matters for sure. I think that the fabric of democracy cannot withstand excessive inequality. But I wouldn't be deterministic about which way that's going.
What are some examples where I think we can cite various examples where capital has been rewarded amply, maybe more than labor? Tell us about maybe some examples that come to mind where labor has been rewarded either disproportionately more than the owners of capital.
Well, I mean, one should be careful about what we mean by disproportionate. I mean, in some individuals' fairness compass or sort of moral compass, maybe you'd want the workers to be paid, almost equal to the capitalist, and so. But just I would observe that, in the 1950s in America, 1960s in America, you had a period when there was a relatively unionized workforce with a preponderance of large industrial firms, big car companies, and so forth, which were unionized. And the unions had quite a lot of power in wage bargaining. There was protectionism, so foreign cars were not a factor in the market. So American capital could afford to give big pay rises to labor because they were not facing Japanese competitors who would eat their lunch. But that wasn't sustainable. Whether that was too much for the workers or not, I'm not going to say. But what I would say is that once you take away protectionist barriers and the Japanese auto industry really took off, then they just were producing far more profits and had profits to recycle into better capital investments. And the Japanese car makers were better because, compensation for, well, not just because of this, but partly because compensation for American auto workers had probably overshot.
The last time there was such rising inequality, right? At least the era that I was referring to earlier, pre-World War One, Europe sees in its aftermath the rise of massive socio-political, socio-economic movements like the labor movement. You mentioned obviously the unionization, etc., that one can argue was part of that labor movement. You see the rise of welfare states, right? Especially in Europe, but I think that phenomenon has then since then globalized also. Of course, you see two world wars. You see this battle between capitalism and communism as ideologies between the US and the Soviet Union at the time. Would you say that today's levels of inequality warrant serious thinking about such similar aftermath, such similar implications, or are we not at that kind of level? Many people are arguing that we are at those levels of inequality now again, where we might see populism, where we might see, many political movements, like one can argue we're seeing in the US. Increasingly, we are seeing maybe in some parts of Europe as well and other parts of the world. Would you say that that's a serious concern right now and a serious possibility right now that we might see similar socio-economic, socio-political movements gain momentum?
Yes, and I think we have seen them. I think that the rise of Trump, who may now be on his way to a second term, and in Europe, the rise of populists across multiple countries: Italy, France, Scandinavia, Holland, and so forth. That's telling us that this political reaction you're talking about is already with us, right?
Yeah.
And I think it's partly inequality. I think also it's to do with discourse about inequality. I think the perceptions have changed in an era of social media. It's more easy to kind of maybe exaggerate and tell negative stories that cause voters to be angry and cynical about the people in power, and that favors the populace at the expense of the establishment parties. So it's a mixture of objective realities and sort of changes in perception because of the way we communicate with each other.
Yeah. And what about within nations, right? We started to talk a little bit about AI, and one of the things that people compare artificial intelligence to is, given it's a general purpose technology, is the steam engine. People compare it to electricity, and as we were just discussing, it's some of the rise of some of these technologies back, in the day where you start to see that the great divergence between nations. What's your sense? I know you're working on AI now. Is your sense that technologies like artificial intelligence might, in some ways, like the power law that you talk about in the venture capital world, would it be that the power law might start to apply to nations yet again, much like it did when the Industrial Revolution came about, where now the rich will get richer, the ones who are AI rich will get richer, and the ones who are AI poor will get poorer, and that we'll see the second great divergence between nations, even though, as many economists have now argued, the last 50 to 70 years we've been living through an age of convergence, where Asian nations, India, China, Southeast Asia, the East Asian tigers have managed to close the gap. But is your sense that emerging technologies like AI might again cause a great divergence and the power law might come into play?
I think what I would say is that artificial intelligence is a sort of A plus technology, but potentially a C minus business model. Because, for example, if you look at large language models, ChatGPT, the Google version, which is called Bard, Anthropic, and various other ones, um, that's not all there is to AI, but that's the thing most in the spotlight. So I'll focus on this as an example. But there's kind of, five or something rival outfits producing this large language model utility. And these guys are going to compete fiercely with each other. And it's not clear whether any of them will make any money because the margins just may be competed down and down. It might be like the airline industry in the US, where you had four or five airlines, and they were all very capital intensive. They had to have aircraft, but for a long period, none of them made any money. Um, and if that were to be the case, then this might actually be fine for nations outside that circle which produces the AI, because everybody can use it. Competition will keep the prices to the users under control. And, it could be fine. It could be positive.
Going back to the point you made about how the stock values clearly show that the tech firms are, really benefiting from their leveraging of technology vis-a-vis, let's say, some banks. If you look at a recent chart that's been making the rounds, Microsoft overtook Apple in market cap briefly, I think a few days ago. And one of the reasons people are attributing it to is the fact that Microsoft seems to be leading in the AI revolution, the AI economic revolution, so to say. And Apple, at least for now, is not necessarily one of those leaders, even though I'm sure it will attempt to catch up and break ahead. But while it could be like the airline industry, it could very well be like the operating system, Android and the iOS, that, or even a Google search engine, which might not make money in the beginning, but you're laying the foundation, so to say, for great returns later. Because, of course, a lot of the applications that get built atop these LLMs will ultimately have to pay some kind of royalty to the ones that own the foundational models. And of course, the other way to think about it is that there's great concentration in terms of capital, technology, top tier researchers, ability to access data, right? In one or two parts of the world. The four or five companies that you're talking about that are the leaders in AI today tend to be concentrated on one coast of one country. And one can argue at best there's another coast in East Asia that might be competing in this world. But then everyone else, like Europe, India, Southeast Asia, might not necessarily have the kind of concentration of these factors of AI production that are needed to compete.
Yeah, I mean, I went to Silicon Valley last month and spent some time there talking to my venture capitalist friends and others. And, I came away with the feeling that the picture that you're painting is the less likely one. It's not impossible. But firstly, I mean, there is competition in building these foundation models that includes Mistral, a French company, includes DeepMind, which is sort of Google DeepMind now, but still the main office is in London, not yeah. There's quite a big foundation model being built in the UAE called Falcon. And that's before we start mentioning any of the Chinese ones from Baidu and so forth. So, and there's no doubt things going on in India, which I don't know about, and you do. um,
So India is
but,
going through a similar exercise. That's right. That's
yeah, yeah. So I think it's a bit wider than you're saying, and also, but the key thing here is that the point you made about the royalties, which people who build products on top of these AI foundation models might have to pay. And the way it was explained to me by people who were investing in the application layer is that you can build an application that runs on top of ChatGPT, but you're able to switch it at low cost to Google Bard or to the Anthropic model or to some other model. And so long as that's technically true, that you can switch between foundation models, I don't quite see how those foundation models are able to extract rents from you.
Yeah, let's move to another topic which I want to get to before we run out of time, Sebastian, which is that of the emerging powers. Right, you started to refer obviously to India and China, and of course other countries in the world. I know that's an interest of yours as well. Tell me of your view, given the technology and the capital trends that we've been talking about for the better part of the last hour. What's your sense of which are the major emerging powers that you would foresee over the next decade as being the major ones that will emerge and become influential either economically or otherwise in the world order?
Well, the basic thesis here is that demography is very important. So large and young populations are a sign of future power, and if you can harness the energies of that young growing population by not having the government do really dumb things and really get in the way, um, then the demographics plus the fact that technology does move across borders, capital does move across borders. So where there is opportunity in terms of a young workforce, preferably educated, you will get a lot of growth. And so putting all those things together, the obvious answers are, the populous Asian countries which are not aging yet. So India is number one, Indonesia is number two, and Vietnam is number three.
And do you expect that with the rise of various powers, including some of the ones you mentioned, but even others, this is a very pertinent question being talked about globally. Are we looking over the next couple of decades at a bipolar world or a multipolar one?
I think it's multipolar. I mean, it's much too complicated to be bipolar. That Cold War paradigm assumed that, you know, countries outside the sort of Soviet and NATO blocs were essentially negligible in their power. And economically, that was true in the Cold War era. It's just not true remotely today. Um, so you're going to see, a US bloc, a Chinese bloc. You're going to have India as, I think, probably an independent actor that doesn't want to be in either of the other blocs, but will want to be its own bloc. And then you're going to see a lot of other significant actors, Europe, which may be in the American bloc, depending on how American politics pans out, but will
How
never be
2024 plays out.
right. But Europe will never want to be totally subsumed into the American one, even if it's aligned with it. And then there's going to be lots of significant, medium-sized actors from Saudi Arabia, to Indonesia, to Iran, Japan, Korea, which are going to be significant players as well. So the bipolar world order is, I think, certainly a thing of the past.
And is this kind of multipolar order, do you think, will bring, I'm sure, a certain set of opportunities, but obviously a lot of new risks, right? So, what are some of the key geopolitical or macro risks that you would think about as you see this kind of multipolar world re-emerge, which we've
Yeah,
not
I think
seen for
that
several decades, right?
the
Uh,
worrying thing is that the multilateralism we've seen in the 20th century was kind of a disguised form of almost unilateralism. And what I mean is that, the Bretton Woods conference in 1944, which gave rise to the World Bank and the IMF, or if you look at the GATT trading system created the following year, these are essentially American-led initiatives. America could lead them because the Russians walked out, the Soviets walked out, and because no other power, especially right at the end of the Second World War when Europe was flat on its back, could rival the US in its influence. And so the US could be, the de facto leader of the non-Soviet world, and sort of mask its own power in these multilateral institutions, which basically it controlled. And when you get into a multipolar world, it becomes much, much harder to muster that what looks like a sort of multilateral, coordinated global effort, but which was really always a sort of masked form of American power.
So someone's called it an empire in hiding. That's right.
Yeah, that's a good expression, empire in hiding. And so what happens when you've got this multipolar world is not only that, other bits of the world which have influence sort of refuse to go along with some American-led scheme, the Americans themselves withdraw from the multilateral order. And that's what we've seen with respect, for example, to trade. So it's not just, Trump, who was sort of crazy and extreme, who pulled out of the World Trade Organization, refused to let new judges be appointed to its, dispute settlement tribunal. No, the Biden administration has continued precisely the same practice. The Biden administration has not lifted steel tariffs on China, even though they have no sort of military strategic justification. The Biden administration has not really revived any multilateral trade initiatives. And that's telling us that it's not, as I say, it's the US itself will walk away from the US created multilateral order when it doesn't control it. And so my worry about the future, a multipolar future, is that it's very hard to coordinate around global public goods, protecting the environment, protecting international shipping, and so forth.
Yeah, it seems like we're seeing the rise of, to your point, I think we're seeing the rise of um, regional or few player organizations in global governance, or one can call regional governance, rather than the umbrella organizations that the Bretton Woods era spawned, right? So you're seeing the Quad and the AUKUS and the, you know, various such smaller groupings emerge around the world that maybe are the future that you are also outlining. No, but great. This has been a fascinating conversation. We've maybe even exceeded our time a little bit, but it's been a great, wide-ranging conversation from the history to the contemporary to the future. I end every podcast, Sebastian, with two questions. One is, and given you've actually, you're an author of 5 books, I'm going to actually make it slightly harder for you. In the sense, I'm going to ask you for two of each instead of one of each. 2 books that you would recommend for people to read, other than your own or mine, if people are interested in the kind of topics and themes that we've touched upon today, that you would recommend. So, 2 books that you recommend, and 2 guests for the podcast that you recommend.
Gosh, okay, so
And don't tell me that these are harder questions than the questions we've been grappling with over the last hour. I often
so
find
in
people to be stumped about this and not, earlier questions. But yeah, so 2 books and 2 guests.
so 2 guests. I mean, one person who I think is brilliant in Silicon Valley is Daniel Gross, who was a Y Combinator partner, now
Okay.
invests in artificial intelligence, and has started his own investment operation. But he's very amusing and thoughtful and sort of non-conventional on artificial intelligence. If you could persuade her to do it, you might find, in terms of the hedge fund world, Marla Gaunkar of Sergo, which is
Okay.
a new hedge fund, very big. She had been the co-chief investment officer at Lone Pine, a well-established hedge fund, and she's a Indian American woman founder, very smart, very interested in technology, and you might find her interesting. In terms of books, um, I read a lot of books, and I get
You do more than two.
but I will I so controversially maybe I think Michael Lewis's most recent book, which is about Sam Bankman-Fried and crypto, is a lot of fun. People criticized it because it wasn't a sort of serious analysis of kind of whether he was guilty or not of the fraud for which he's been imprisoned. But I thought it was a terrific character study of a wild, wacky entrepreneur. So that Michael Lewis book I recommend. Um, and there's a book, an old book called Machines Who Think,
Hmm. Okay.
which is a sort of history of the very early phases of the artificial intelligence movement back in the 1950s. And I think if you're trying to get a historical perspective on what's going on now, I recommend Machines Who Think.
No, great. Both great recommendations. I haven't read either of those, so I look forward to reading those books as well. And great recommendations for the podcast guests as well. Thank you so much. This has been a great conversation. I hope you've enjoyed it as much. And of course, if travels bring you to India, Sebastian, please do let us know. We'd love to have you over in India. I think you'll find that um, it's changed a lot depending on when you were here last, and changing very rapidly. But you'll find a lot of interesting, thought provoking trends going on in India, whether it's tech related or capital related, and of course, just broad macro trends also playing out on the grounds and streets of India. So I look forward to meeting in person as well. Thank you again.
Wonderful. I enjoyed it. Thank you very much.